Welcome everyone to this TradeStation webinar. Thank you for taking the time out of your schedules, to learn a little bit about the markets, about trading, and the TradeStation platform. Just a little bit of an introduction. My name is Jesus Nava. I'm the Director of Education right here at TradeStation Securities. It is always a pleasure to host these types of events where the whole purpose is to teach you something new about the markets. And today we have a treat. Brandon Wendell is joining us in just a moment, and I'll pass the microphone over to him as I finish my introduction. But he's got a very interesting topic today. Before we get to it, the usual disclosures, keep in mind that every symbol and idea that we talk about in this presentation is for educational purposes only. These are not recommendations of TradeStation. Also, that active trading is not suitable for everyone. It should only be done with risk capital, and that past historical performance is no guarantee of future results. If anybody needs a little bit more information on the disclosures, you have the link right there on this PowerPoint slide, www.tradestation.com/important-information. So as I said at the very beginning, we have a guest speaker. His name is Brandon Wendell. It's not the first time we have him, and we're very excited to have him again talking about options. Brandon brings decades of trading experience and trading knowledge, so it's a treat to have him here. He holds the CMT designation. I'm not sure if anybody here knows about it, but it's a chartered market technician. And I'm just very excited to hear him out and let him, do this presentation. His title, it was at the very beginning, I forgot to mention it, is Finding Trading Opportunities Using Zero-Days-Til-Expiration Options. I find that the topic very fascinating, so let's give him all our attention. I'll pass the microphone over to you, Brandon. Welcome to the webinar.
Thank you very much, Jesus. I'm going to go ahead and share my desktop with you guys, so that way hopefully you can see that. So screen 2, share, and we should be good. So let me go ahead and bring up the chat so that way I can stay in touch with everybody. So yeah, I'm no longer with that other company. I actually I'm an independent contractor for a couple different places, TradeStation included. Actually, it's a little disclosure that I have here as well. But yeah, I've been involved in the markets, as Jesus mentioned, for about 2 decades, a little bit over that. I started off as a retail broker, kind of hated it. And I moved into the back office operation. So I did trading there. I was actually the trader for the brokerage, where orders would come in. I dealt with the market makers and was shipping those orders out to the markets to get them filled. So that way we made money and got some commissions. I ended up leaving that and working for a private hedge fund, traded for a little while there, ended up leaving, going into the education space. And basically I worked for over 20 years now, teaching traders how to navigate the markets. And it's been a lot of fun. So I'm here trying to give back a little bit and enlighten you guys, as the title says, a little bit about what are called weekly options. Kind of misnamed a little bit, but before we get started, I have to do this a little bit of an additional disclaimer and disclosure. I am not a registered broker dealer investment advisor. I'm going to look at different securities for demonstration and education purposes only. Just because I look at them doesn't mean that they're appropriate for you. So I am an independent contractor for TradeStation and also for Wealth Builders HQ, and they're not affiliated with each other. Anyway, again, I'm not giving any personalized recommendations. I might have I'm not subject to trading restrictions, so I could have positions in the markets and can open them at any time. So that being said, the legal stuff's out of the way. Just a quick background, as Jesus mentioned, I'm a chartered market technician, which in a way is kind of a master's degree in technical analysis. So I've learned a lot about the different ways of charting the markets. And thank you, Steve, and welcome everyone. Hello, Jeff. And see all these, well, I can't really see the faces. I was going to say faces, but I see all the names of people I recognize there from years back. So anyway, I was a former hedge fund manager. I did that for a little bit, private hedge fund. I was a former trader for the brokerage I mentioned. Been doing this for quite some time. And my mom says I'm a really nice guy. So that's a great endorsement there. I think my wife likes me too. So jumping into the topic for today, what we're going to cover a little bit is what are weekly options? And we'll talk about some of the risks and advantages of those types of options, because they are slightly different than what we call traditional monthly options. So yeah, ODTE was a company I used to work for, no longer affiliated with them. Been a couple of years. Anyway, we're going to go into credit strategies. And it's interesting when you talk to a lot of professional traders, you'll find that many of them are on the buy side, the sell side of the equation rather than the buy side. Just out of curiosity, because I know we got a lot of people in here, how many of you are currently trading options? 1 for yes, 2 for no. You can just type it in the chat if you'd like. But I'm just kind of curious how many people are trading options now. 1 for yes, 2 for no. So quite a bit. Okay. Good. Okay. Just kind of getting a feel for who's in here. We got a lot of people. So some people are already doing Zero-DTE as well. Okay, great. And if you've never traded options before, I mean, I'll try to keep this relatively simple, but this is a little bit more, weekly options are for a little bit more advanced traders rather than, honestly, it's not that bad. They're very similar, as we'll see. We're going to talk about that. But I mentioned that a lot of professionals are more on the sell side than the buy side. And we'll talk about why that is as well. We're also going to talk about finding trading opportunities for potential income on an intraday or regular basis rather than looking at long-term. Many people that trade options typically look at them for a long-term perspective where they might be in a position for at least a couple of weeks to a few months. However, with these new weekly options, you can actually take positions intraday for potential income, as I said, but there are risks involved, obviously. And we'll talk a little bit about using OptionStation Pro, which I realized I just forgot to log into. So I better open that up. Anyway, so I'll log in real quick as well, because I am going to be referring to the platform and talking a little bit about the platform. So let me go ahead and do that. As you can see, it's really easy to log in. I've been using that program for quite some time. So it'll take a little bit to get that up and going. While we're waiting, we'll continue on. So again, I'm going to introduce you to weekly options, what they are, how they work a little bit, the risks, and the fun part about them as well. So they were introduced in 2005 by the Chicago Board of Options Exchange, or CBOE, CBOE, and they've kind of changed a little bit. They have many of the same characteristics as normal options, and they call them standard options. Standard options, they have monthly expirations. They expire typically on the third Friday, technically it was Saturday, but third Friday of every month. And these are a little bit different. They have a shorter lifespan or shorter cycle, expire every Friday or every day, depending on the type of option you are trading. So they're the same, but different. The weekly options have weekly expirations, as I mentioned. So they expire every Friday, except for holidays. They'll move it back on Thursday, or if there happens to be a standard option expiring on that Friday, there will not be a weekly option for that week. Okay, so they can only have one option expiring every week. It's either a weekly or the standard monthly. Okay. So in 2022, it's actually relatively new. So last year, I don't remember the exact date, but I know that last year they expanded the expirations on certain securities like the S&P 500, which is the one I'll be talking mostly about. Now you have what they call weekly options, but they expire every day. I know they should probably call them daily options. They don't. Okay, for whatever reason, they just call them weekly options, but they do expire Monday through Friday, except for holidays, or again, when a standard option would be expiring. So when we look at an option chain, actually, let me see, do I have, nope, it's not open yet. So let me go to my apps and OptionStation Pro. Go ahead and open that up. This is just a simulated account that I'm playing around with. And there we go. I guess speed up my computer a little bit. So looking at Apple, for instance, that's the first one I was looking at here. If I go to the options tab and collapse this, you'll see that we see weekly options. Actually, let me zoom in a little more. Hopefully you can see that better. You see we have options expiring in 2 days, which would be Friday, right? So we have weekly options. Then you have a standard option, 9 days, and then weekly, standard option, weekly, and then standard. Now, if we go to an index like the SPX and take a look at the option chain there, you'll see we have more choices because on some of those indexes, instead of waiting for every Friday, you actually have expirations every single day. So right there, you can see we had expirations today on the 7th. We have tomorrow, we have Thursday, Friday, next week, Monday, Tuesday, Wednesday, and so on. Okay. So yeah, they did have Monday, Wednesday, Friday for a little while before they expanded them to every single day. And they had the standard and the Friday both in the same week. I don't recall, but maybe they did. But now I know that they don't. They typically have the weeklies or the end of month. So you see for the SPX, the 27th is weekly, 28th is end of month instead of having a weekly expiring on the day. So whatever they did, they changed it that way. So similarities, again, the calls and puts are very similar when you look at the options, and the pricing is going to be very typical as normal options. The exercise and assignment is the same as well. And the rights and obligations are similar to the standard options. Let's see, are SPX options typically better premium than a SPY counterpart? I'm not sure about that. There may not be. And here's part of the reason why. When you take a look at, let's see if it shows it here. Let me do a drop down. I'm not sure where it shows it here, but what happens is when you're dealing with the index, excuse me, these are European style options. European style means you cannot exercise early. You can only exercise at expiration. So if an option's in the money and you want to get, well, again, you can't get stock on an index, it's cash settled. But if you were to go to SPY, there is slightly more risk for the option seller because those are American style options, which means if you have an option that's trading in the money, meaning it has value if you were to exercise, you can exercise it even before the expiration. So since the European style options cannot be exercised early, there is less risk for the seller of the option. Therefore, the premiums will typically be slightly lower because less risk, more reward, more premium. So again, that's just, they're very similar though. I really don't notice much of a difference. For instance, we have, let's see here. Skipped on me. We got February 9th. Okay, so we have a little bit of time until expiration there. If we take a look at the 409, we got 645 on the 409s. But if I go to the index, we have to find a very similar one. And that one is slightly in the money right now. We'll go about an hour and the recording will be available. You got to give it a little time because they have to go through compliance and review everything that I say, make sure the video is okay, do some editing as well. So expect it to be up in, I don't know, maybe a week or so. It'll be available on the channel for TradeStation. Anyway, getting back to where we were, you can see that these are going to be a little bit more expensive because we're dealing with the index. And again, if I look at the area, no, they're definitely priced a little bit. Did I get the right one? I didn't. Need to go to the right one, the 9th here again. But again, you take a look at the pricing and or after hours as well. So everything's going to be a little the pricing, but they are going to be a little bit more expensive. However, you do have less risk because they are European style options, as I said. Anyway, some of the advantages, number one, short-term opportunities. You know, you can get in and out of these options without having to wait for months or even weeks. There are expirations every single day. That also allows you to do more precise strategies and it gives you more opportunities to trade. The risk, though, is you have less time. You know, if something's going against you, you've got less time for it to come back and go in your favor, right? Some of the options you can wait a little bit longer if you have standard versus the daily. There also is some smaller open interest because there's more time left. There's a lot more trading on the standard options than there are typically on the weeklies. I mean, think about it. In 1 week, you've got 5 different options to choose from. So not everybody's trading the same thing. So the open interest might be slightly lower. That means it could be a little more difficult getting in and out of positions, but not really. It depends on what you're trading. And obviously, if you trade more, you run the risk of making more mistakes, but you also have to pay more commissions. You know. Options are relatively simple tools, even if you've never traded them before. You've got 2 types of options, and there's only 2 things you can do with them. You can buy them or sell them. A call option, I liken it to a coupon. It allows you to buy something at a discounted price, but you have to use the coupon before it expires. So if you buy a call, that is nothing more than a bullish strategy. You are hoping prices rise, so the value of your coupon also rises. Well, everything's equal and opposite. So if you sell a call, that is a bearish strategy. because you want the coupon to expire worthless. Buying a put is a bearish strategy. It's kind of like insurance. You buy an insurance policy because you think that the value of something might decrease and you want to be protected in case if it does. Well, if you are selling a put, that means that you are bullish on that strategy, or sorry, on that security, because you expect the price to stay the same or possibly rise. So you can either be bullish or bearish, whatever you want on a security, and you have two choices. You can either buy or sell calls or puts. Well, we're going to take a look at what are called credit strategies. And these strategies are the sell side. So going back to the slide right here, you can see we're going to be on this side operating there because we're going to be receiving premium. We're going to be selling options. Now, the one thing I like about selling options is you typically get more opportunity. Now, it doesn't mean you're going to win more, okay? But you get more opportunity. When you think about it, I'll go back here. If you buy an option, you only profit if prices go in your favor, and they have to do it within a certain amount of time before that option expires. However, when you sell an option, for instance, selling a call, I mentioned it's a bearish strategy. Well, you profit obviously if prices do drop because the red arrow shows you, but you can also profit if prices were to go sideways, and you can still profit even if prices rise slightly, but not that much. That means you have three different ways the price can move, and you can still potentially profit in a call option if you sell it, versus only one strategy or one way if you buy the option. So I don't know about you, but I'd rather have three possibilities rather than just one possibility to make money. So I like selling options. Anyway, those are called credit strategies. And then we're basically going to be dealing with what are called the Greeks when we look at these options. The Greeks are risk parameters. It gives us an idea of what is going to be helping or hurting our position. So that's all it is. It's a measurement of risk. And we have several different Greeks that we deal with. One that many people are very, they know a lot about it and they favor it quite a bit, is called delta. And that is how much the premium of the option will move with the $1 move of the underlying security. So when you say delta, you think D, directional movement of the underlying security. We have theta, and T is for time. So it's how much premium will decay every day as time passes. See, options are a wasting asset. Okay, they decay in time. I liken them to a piece of ice. If you get an ice cube, it will melt if you hold it outside long enough. I mean, unless you're up in the north and it's really cold. I'm in South Florida, so it's pretty warm here. It'll melt fast. But basically, options decay or melt, if you will. And if you have a small piece of ice, it will melt much faster than a large chunk. And that's what happens with options as well. If you have very little time left until expiration, the time will decay much faster than if you have a lot of time left until expiration. Let's see, is there a positive expected return on the sale of shorter duration premium? Not necessarily. I mean, the time you're talking about selling an option, is it a possibility of making money better when you sell less time versus more time? Maybe, maybe not. It depends. Now, remember what I just said about the options. If there is less time, they will decay faster than longer time. So there may be a bit of a possibility there, yes, depending on your strategy and what it is you're trying to do. But the simple answer is yes, there may be a higher probability of profit by selling a shorter time to expiration. Did that answer the question, hopefully? What level does a trader have to be to sell options? Great question. For those of you who may not be aware, there are typically 5 levels for options traders. It's based on experience and how much money you have in your account. And every broker is a little bit different. Here at TradeStation, they have 5 levels, and you have to qualify a certain level in order to be able to sell options. And you have to be able to qualify to either sell them with collateral, meaning they're covered. Okay, and there are different ways of doing that: covered calls or married puts using cash or stock, or what we call naked, or using another option to cover the position. And that's what's called a spread. I believe it's level 3 for the spreads, but don't quote me on that. The best thing to do is look at the TradeStation website and see exactly what they state for you, or talk to your representative at TradeStation and they'll let you know. But I believe, off the top of my head, I believe it's level 3. for the spreads. Okay. Vega, by the way, is probably one of the most important option Greeks, and that is how premium changes based on a change in volatility of the security. Okay, so we'll talk about that. V is for volatility. So there's somewhat easy to remember, delta D direction, theta T for time, vega V for volatility. And I'll actually get to the calls and the bids and asks in just a little bit. I will cover that. Don't worry. Okay. And let's see, how far in the money and how far out of time is the best? It depends. It's going to be different for each security. To get a dollar move in a stock, it really depends, honestly. If you were taking a look at stocks that are priced around $10 to $15, they're not going to move one full dollar in a short period of time. But if you're trading a stock that is valued at $1,000 or even $500, it can make a $1 move in no time at all intraday. So it really depends on what it is you're trading. Anyway, when we go back to our option little graph right here that I created, again, we have calls. If we buy a call, that's a bullish strategy. We know that. But we need to know, how will the Greeks affect us? Well, we get all those in there. If we are buying a call, the direction is positive. Remember what I said about buying options, you profit if prices move in your favor. So if the price moves up, calls, if you bought them, will make money. However, it's an ice cube and you bought the ice cube. So time is your enemy. The longer you hold on to an ice cube, the more you're just going to have a puddle of water in your hand by the time you're done. So theta is negative. Volatility also affects the price. As I mentioned, it's probably the most important one. And as volatility rises, the value of your option also rises. So vega is positive. And it's pretty simple. If you have a call and you're buying the call, when you go to the sell side, everything will be opposite. So we look at the delta, it's a negative. That means if you sell a call, you profit when prices move down. Well, it's pretty much looking at the red arrow. If you see the red arrow, that's negative delta. If you see a green arrow, positive delta. That's all. Will we talk about how to utilize Vega? Yeah, we'll talk a little bit about that. Absolutely, Jason. And what is the best overall option to trade daily stock or index? It is a personal choice. I prefer to trade the S&P 500 index futures PM settled for daily opportunities. You might like something else. Okay, there's not one perfect option that's best for everybody. So you got to find what works best for you, but we'll talk a little bit more about that. Anyway, when we go to the puts, not everything is opposite from the call. Okay, when we're buying, we're still going to have positive delta. I'm sorry, not positive delta. We're going to have negative delta. What I meant was we're going to have positive data. Okay, we're going to have negative delta again because of the red arrow. If you have a red arrow, you have negative delta. Green arrow, you have positive delta. You see that on the sell side of the put. And when you have a buy, that affects your time. So theta is also negative on the put. Vega is also positive because you bought an option. Okay. Well, thank you. I'm glad you enjoy it. What is the symbol for the ES futures asset? It depends on the platform you're trading. Okay. With TradeStation, you have to use what's called TradeStation Futures Plus, which if I have time, I'll log into that and show you as well. But actually in the masterclass that Jesus does, he goes over a lot of those tools. So you can probably look in the archives and find some of that as well. Okay. Anyway, so right here, again, when we look at the puts on the sell side, you can see that delta is a positive, theta is a positive, and vega is a negative. Okay. So that gives you an idea of what is going to affect you when you are trading these options. And one of the interesting things is when we do spreads, we're going to pick one from each column and try to neutralize some of those negatives, or I shouldn't say negatives. We're going to neutralize some of those risk parameters by creating spreads. Okay. So when it comes to delta, I mentioned it's movement in price. Delta is simply the price movement of your premium of the option for a $1 move in the underlying security. So if you have a delta of 4.45 or 45%, it means the option premium will move 45 cents for every $1 that the stock moves, either up or down. And obviously, if it moves less than $1, you would just multiply by that factor, that 0.45, to figure out how much the premium would move. The nice thing is we don't have to do it ourselves. All you have to do is have a platform like TradeStation Option Station Pro that does it for you. Anyway, positive delta moves with the stock. So if you see positive delta, it means that if price goes up on the stock, the option premium will go up as well. Same thing with futures, options on futures, because you have those too. If you have a negative delta, that moves opposite. So if you happen to have a negative delta of 0.55, if the stock moves up by $1, your premium will lose 55 cents. However, if the stock goes down by $1, premium would actually rise by 55 cents. So negative deltas move opposite of the underlying price. Okay. There's no necessarily a recommendation for 0DT iron condors. We'll talk more about that. Moving on, theta, time decay. Okay, so if you have a negative theta, that's how much you're going to lose in premium every single day that passes. And when we talk about days with options, we're talking about at the close of business, which is 4 p.m. Eastern. That's when everything changes. You can't trade the option anymore. It rolls over, you lose your theta or gain if you have positive theta. So if you're selling premium, you get positive theta. Again, it all goes back to this right there. If you are buying options, you have negative theta, you lose every day. If you sell options, you have positive theta, you gain every day. Okay? It is pretty much end of day. However, when you're looking at some of the dailies, there will be an intraday effect. You'll see it starts to adjust at certain times. Okay, oops, there we go, we're on theta. So the last one is Vega. Now, there are a couple other Greeks, but they're very limited in the effect on the weekly, so we're not going to talk about those right now. But you have Rho and you have Gamma. Okay, it's going to be a more advanced topic. Anyway, Vega is the effect of volatility on premium. And I said it's the biggest effect. It has more of an effect than anything else. Buying options gives you positive Vega. So if volatility goes up, the premium, the value of your option also goes up. Okay, that's true. You can trade the Q and SPY 15 minutes after the close, but you got to check when the settlement is for them. So if you sell an option, you get negative Vega. So basically, you lose profits if volatility rises. It goes the opposite direction. Okay. We're going to get into more of this a little bit later. So let me keep going here with what I'm doing here. And again, this is just a review of what we just looked at. If you buy options, buying a call, well, first of all, if you buy options, you get positive Vega and negative theta. And then depending on which option you buy, it changes the delta. When you sell options, you get positive theta and negative Vega, and the delta is depending on which one you sell. All right. So just keep in mind that if you're looking at some of these credit spreads, the face value of the reward versus risk, it looks terrible. It really does. It looks like you're going to lose a whole lot compared to what you're going to gain. The reason why that you do this, though, is the probability is much higher. Remember what I was saying before, when you do a directional trade and you buy an option, you only profit if prices move in your favor in a certain amount of time. When you sell the options, you make profit if prices move in your favor, go nowhere, or move slightly against you. So you have higher probability of profits, even though you're taking in less profit. And one of the things you can do to kind of mitigate the losses is traders can put on stop losses to protect themselves. So you see that there's a certain amount of maximum risk. A trader never has to accept maximum risk. They can adjust the amount of risk they will actually take by using certain things. Okay. Let's see. Yeah, there can be some volatility crushes and things I mean, unfortunately, whenever there's money involved, there may be manipulation. And markets are not immune to this. Option markets are not immune to this manipulation. You do have the specialists at the SIBO. Everything's done by computer now. So can prices get manipulated? Possibly. I don't have any proof that says it absolutely is, but yes, things happen. Anyway, the credit spreads can reduce directional risk and volatility risk because you're going to be buying and selling options at the same time. Remember, going back here, you're going to be on both sides. If you're buying and selling, you're going to be neutralizing some of these. And we'll talk about how we do that. Credit spreads pretty much are profiting maybe from volatility collapsing, but mostly from the passage of time. So if you're worried about getting crushed on volatility, you could try to take the Vega out of the equation. And we're going to talk about how we do that. So credit spreads, as I mentioned, you're buying one option and then typically selling another option to offset the risk. And it also can reduce some of the margin costs. So traders basically will sell an out of the money option and then buy a deeper out of the money option. And it just depends if you're doing calls or puts. So the credit you're receiving from selling an option is going to be greater than what the trader's paying in the option they're buying. Therefore, it results in net credit to the trader. That's it. Whatever premium is received in that position is the maximum profit that can be received. Okay, when traders sell options, excuse me, the most they can win, so to speak, is the premium they receive when they sell the options, period. So when they open up the position, they're max profit. So again, kind of putting it all together here, if we sell puts, we have positive delta, positive theta, negative vega. So we profit if the price of a security goes up, and we lose money at profit if this price goes down. We profit from time decaying, and we lose money if volatility goes up. Well, if we sell a put and buy a put, you'll notice we're getting delta that's negative to offset the positive delta. We're getting negative theta to offset the positive theta, and we're getting positive vega to offset the negative vega. So we're going to offset some of the what do I want to say? The things we don't like about the option. And if we're doing the calls, it's the same thing. Sell a call, you have negative delta, positive theta, negative vega. When you buy the call, you're offsetting the negative with positive delta, the positive theta with negative theta, and the negative vega with positive vega. Undesirable effects. Yes, thank you, Steve. I appreciate that. Okay. That's exactly what I was thinking about, the undesirable. So options seem to be a little pricier now than normal. That's because of volatility. When volatility rises in general, options are going to be more pricey. So when you're seeing the markets in general getting very volatile, and we just came out of earnings season. So when there's unknown like earnings, volatility typically rises. And that's why you're seeing higher price. They'll calm down now that most of the earnings have been released. Okay. Anyway, when we're talking about reducing risk here, we're looking at calls and puts of a security. This actually happens to be the S&P 500 index that I used. And you can see we have a delta on the call side of 0.54. On the put side, the delta is negative 0.46. Okay. So if you end up doing a, long call plus a long put, buying one of each, you're basically combining those deltas because you're buying at positive 54 and you're buying at negative 46. That means your delta. And by the way, when I did the screenshots, it didn't quite line up because prices were moving. So that's why the number, it shows 0.7. It should be 0.08, but again, time moved. Or I should say prices moved. Anyway, here you can see Vega buying the call gives you positive 3.52. And you got a positive 3.52 on the put side. So now we have more Vega. So we've actually increased our volatility risk. That may be a good thing. If volatility is very low, we're expecting it to rise. It's a bad thing if volatility is already high and it collapses. Well, looking at the last one with Vega, if you buy both of those, you have a negative 160 and negative 121. Now we've increased the negative theta. So time is hurting us more than it was before. This, by the way, is a straddle if you're buying both a call and a put at the same strike price. That's not what we're going to be using, by the way. This is just an example of what happens when you combine the two. Okay. So now if we want to reduce risk, back here, basically we increase the risk of volatility collapsing on us and time decay. Now, this could work if we have very, very low volatility and we're expecting it to explode or rise. Okay. But if we want to reduce risk, we can do that as well. So here we can go long on a call and short on a call. But notice we're going long on the 39.75, going short on the 39.80. And what happened when we went short is we flipped the operators here. So instead of a positive 160, negative 160 theta, now we made a positive. And the delta went from a positive 0.54 to a negative 0.54. So we're basically combining those two. We bought the 75 and sold the 80, and our overall delta now is 0.02. So that means we have almost no directional exposure. It doesn't really matter if the price goes up or down, because for every $1 the security moves, we're only going to make 2 cents. That's not much. We'll take a look at what happens with the theta. We've been able to reduce the theta as well. We had the theta, the long call of negative 161, plus the short call of 160. Now we have almost no theta. So it doesn't matter how much time passes, we're not really losing from the effect of time. Basically put the ice cube in the freezer. And we've also reduced the vega in this case. You can see the long call, 351, the short call, negative 352. We've almost eliminated the vega as well. I'm not saying this would be a good security to trade or a good position, because basically it's almost impossible to make money on this one. What's going to make money? We're not getting direction. We're not getting time. We're not getting volatility. Something else has to help us. Sorry, excuse me. Well, we're going to take a look at something called a bull put spread. Now we're going to start to look at a little bit of directional movements here. So if we're looking at a bull put spread, we have 2 legs or 2 different options that we're going to be putting together. The first one is called the anchor leg. Okay, and that's what kind of drives the profits and drives the strategy itself. Okay. So that's going to be the short option in this case, because we're doing a debit, or sorry, not debit, we're doing a credit spread. We're trying to profit from premium received. The short option is going to be the driving force for that. So a trader would sell an out of the money put to collect premium. Remember, if you're selling a put, you want prices to go up, right? Because if you're selling the put, that would be the green arrow. Now, the strike price, to make it a little bit better for you, should be below what we call support, or a demand zone is what I use. That goes into something else. But we're basically looking for where prices are not likely to go. If they start to go down towards that level, they're likely to bounce from that area. Okay. So the strike should be below a support level. And we then do what's called an offset leg. So the anchor leg really drives the strategy. It's telling us what we want to have happen. It's how we make our profit. The offset leg helps us reduce the risk, and it lowers the amount of cost in the position itself, either the margin or the premiums. So we're going to do a lower strike option. It's further out of the money, and we're going to buy that one. Again, we're offsetting those deltas or thetas or vegas, the Greeks. And we do this also to lower margin requirements. We are using this option that we buy, or a trader would buy that option to reduce the risk from the one that they sold. Okay. Oh, sorry, I was just looking at the, all right. Anyway, the delta offsets the delta of the anchor leg, the vega offsets the anchor leg, and the theta offsets the anchor leg, but it will not offset it as much. So you will profit from theta overall as time decays. So if we look at kind of an example here, this was on the SPX some time ago, and basically we could sell an option below an area we believe prices will not drop. So if right here, I think the price is going to stay above that 45.91 to 93 area, we could sell the 45.90 put. And then the trader, to protect themselves, would buy the 45.85 put. That's a 5 wide option, meaning there's 5 strike prices there. They do have weekly options. This is a TradeStation right here. You just have to use the right symbol. The symbol that you're going to be looking for, and I'll talk more about it, is $SPXW.X. That's the one, the correct one there. Okay. And then you see it says S&P 500 PM settled index. We'll talk a little bit more about that too. And there they are. There's weekly options every single day, except for holidays. So if we see an area where you think prices will not go below, we go ahead and sell. Again, you sell the put and then buy the put lower. And this is what happens. Now, first of all, this was a question that came up earlier. There are 2 prices that are available on these options. You have what is called the ask price and the bid price. Okay. So we're looking at buying the, in this case, 38.60 put and selling the 38.65 put, the higher strike put. Okay. Now there's different prices. No, you would buy the option lower. You are selling it put below support, and then you're buying a lower strike put. I know it's physically higher there on the screen, but it's actually a lower price. Okay, so you got to buy the lower price. Anyway, right here, you can see that if you were to naturally do this, there's two types of spreads being shown. Okay, and two different prices typically being shown, especially on TradeStation, they do this. You have what is called the natural spread. If you want to buy something quickly, you typically have to buy from the ask price, which in this case would be $3.30. Okay, and that's what it's showing right there. Bought the put premium $3.30. If you want to sell, you sell to somebody who's willing to buy. And that would be, in this case, the $3.70, the bid price, because they're bidding, they're willing to buy from you at that price. Well, you don't have to take that price, and you probably shouldn't. You want to negotiate. Those are retail prices, okay? So, yeah, I was answering Roger's question. Sorry about, you sell an option at a price below support and you buy a lower strike price put. And yes, you sell, as Eric is saying, sell an expensive option to buy the cheaper one because you want a net profit. Anyway, we don't have to spend $3.30 to buy that option. You see, there's a difference between what they're willing to buy and where they're willing to sell. You could try to split that, and that's called the mid price. You might not always get it, but you can at least try for it. And the same thing here. If we're selling an option, we don't have to sell at the lower price, $3.70. Okay, you can try to get a better price because they're selling at $4. You can try to go somewhere in between. So you see on TradeStation, they show you the natural spread, which is the retail prices, selling $3.70, buying $3.30. Well, that's 40-cent credit. Or what's called the mid price. The mid price here for the sale is between $3.70 and $4 or $3.85. And then buying is the middle price between $3.10 and $3.30 or $3.20. And you can see there's more premium to be had if you do that. So the advantage is you can make more premium. The disadvantage is you might not get filled. Okay, you have to wait to get filled possibly. But that's why there are different prices there. So anyway, the credit received in this case, we were getting the 65 cents, and basically on the slide, I'm using the mid price. That's the max profit you receive in the trade. That's it. That's all you can make. You'll notice the combined delta is now 2.78. The combined theta is 1510, and the combined vega is 314. So the highest number and the biggest profit is going to be coming from time decay, right? $15.10 from time decay every day versus if delta changes, a $1 move in the security is only $2.78, and a 1% move in volatility only affects it by $3.14. So what we've done is, again, try to combine the two different options to get the effect we want, which is time decay. We have a very large theta at this point. And we've also reduced our risk. The max loss is going to be the price difference between the two strikes. In this case, there's 5 points. Remember, options are 100 shares. I know we're trading an index, so it's not really shares, it's $100. So the maximum risk you could lose if you were exercising both options would be $500. But we collected $65 in premium, so therefore our max loss is only $435. That's how they come up with that. Okay, so that's a bull put spread. Basically, it's a bullish strategy. We are selling a put and buying a put to offset and get the undesirable effect of the vega and the delta out of the way. And because we have almost no delta, it doesn't matter which way prices go, right? They can go up, they can go down a little bit, and they go sideways. As long as they don't go in the money, we can profit. When the options expire, the trader who sold this would keep the premium. Now, if you're bearish, there is what is called a bear call spread. Now we're going to be using call options, and the anticipation is that the prices will go down rather than up. So in this case, the anchor leg is selected first. That's the one that makes the money. It's going to be a short option. So the call is going to be sold to collect premium. And it should be sold above a resistance level, basically, right? Or what I call supply. We're looking at where prices are not likely to go. and the trader would sell an option above that resistance. The offset leg is going to be a further above a higher strike option. And they're doing that, again, to reduce risk, to reduce costs, and maybe you can't sell naked options, so they're also offsetting that, okay? So basically, the trader buys that option to lower margin requirements. I'll get to that in a little bit, Hillary. So the negative delta offsets the delta, the positive vega offsets the vega, and we're going to try to profit. If you sell a bear call spread, traders try to profit from the decay of time. Basically, you collect the premium, option expires worthless, the trader gets to keep the premium. That's it. Pretty simple. So here is an area of resistance that was identified, and the trader was selling a 4,600 call above the resistance and buying a higher call further out of money, 4,605. So the profits would come if prices continue to go down, or they would profit if prices go a bit sideways, or they'd even profit just a little bit if prices go up, but don't go above 4,600. So 3 different ways to potentially profit. And when looking at a bear call spread, you'd be selling a call and purchasing another call at a higher strike. You see the choice here was 39.30, 39.35. So the lower strike call was being sold, the higher strike was being purchased. And there's also the 2 different spreads here and prices that can be done. Typically, if you're buying retail, you would normally buy from the ask, you would sell to the bid. And if you just take face value, what they're willing to give you, that would be 90 cents for the natural spread, because the call would be sold at $5.30 right there, the bid price. And the call would be purchased at $4.40, the ask price. So that difference is 90 cents. But you can always try and negotiate and get a better price. The mid price, meaning the difference between the bid and the ask price, those two combined, we have a sale at $5.45, a purchase at $4.30. So now the collection is $1.15 at premium. Okay. So the advantage is if you split the spread, you can get more premium. The disadvantage is you might not get the trade. Somebody on the other side, those specialists at the SIBO have to decide to take that trade. And they have to take the contra or have somebody else matched up with you to take the contra. Anyway, the credit received in this case is the maximum profit, $1.15. Or $115 for one spread. Before I go further, the max loss is, again, the difference between the 2 strikes, in this case, 5 points or $500 minus the credit received. So it's $385. And the combined delta, negative 371. So this profits when prices drop because it has negative delta. The theta is 56.89. It's a positive theta. So this profits from the time passing by and the option value decaying. And volatility is negative vega, so therefore it profits if volatility collapses. If volatility rises, it loses a little bit. But once again, you can see the majority of the profits are coming from time decay. And that's what we want when it comes to the vertical spread. Now, the iron condor, somebody has mentioned that earlier, the iron condor is nothing more than those 2 spreads put together. If you do all of those spreads, you do 4 options. You sell a put, sell a call, buy a call. If you do all 4 of those, that's called an iron condor. It's a bull put spread and a bear call spread. That's all. Volume does affect the spreads, absolutely. Okay. Is Zero-Days-Til-Expiration very risky? Anything's risky. It depends on how you, well, the risk when it comes to Zero-Days-Til-Expiration is you're going to be taking more trades potentially. Somebody who trades monthly is going to be trading less than somebody who trades those weeklies, right? Because there's 5 trades a week on the dailies, or sorry, the weeklies compared to 1 a month. So there's obviously more risk there. But there's going to be more reward with it because there's more potential. But yeah, you can reduce the risk. Exactly. Let's see. Anyway, the iron condor is nothing more than a bull put spread and a bear call spread, and profits typically from very little to no movement in price. When it comes to the bull put spread, that profits, remember, from prices either going up or staying sideways. The bear call spread profits from prices going down or moving sideways. So if you put both of those together, you basically are framing where you want price to stay, and if price stays in that range, the profit comes. If it goes out of that, that's where you would lose. So I love selling premium. That's what I was saying. Most professionals will be more on the sell side than the buy side typically. So you cannot get Tom, remember what I was saying at the beginning, these are European style options. If you do it on the S&P index, there is no early exercise, no assignment. So you don't have to worry about that. That's one of the beauties of that particular strategy. If you do it on the SPY, yes, there is early assignment possible. Assignment, by the way, if you're not aware, is somebody decides they actually want the stock and they exercise their right to get that stock as well. Okay. And absolutely, Pat, I'm not going to go into the whole tax thing necessarily because I'm not a tax professional, but using the indexes, they are cash settled and they're treated like 1256 contracts, as you were saying there. But talk to a tax professional because I'm not one. Anyway, iron condor, you're doing the bull put spread below a support or demand zone and selling a bear call spread above resistance or supply. Basically, as long as prices stay between the two options that were sold, the profit is there. And the profit will always be no more than the premium collected, right? This is what the risk profile of an iron condor looks like using OptionStation. So it's actually pretty easy to build one of these and show it on the screen using OptionStation Pro. You simply choose an iron condor, choose the right strikes that you want. Obviously, you should have been doing the charting first to know where prices are not likely to go. Okay. Great question, Eric. How do you determine the support and resistance levels? You got to know. You got to get educated to know how to find those on the chart. Plain and simple. So if I were to do this as an exercise right now, let's see. To the right security. Let me take this off. There we go. There's the index. And depending on the time frame you wish to trade, I actually do quite low time frames typically. Oops, what happened there? What did I do? What the heck just happened? I'm going to go down to a 15-minute time frame. There we are. And I was playing around with this, so I need to disable some of this stuff because I don't use those. Anyway, price is all you really need. There we are. And taking a look at your charts, you just have to know what to look for. For instance, today, I was actually looking at, let's see here, horizontal line right here. On the 15-minute time frame, I'll zoom in a little more. It's not what I wanted to do. But you can see right here, this is an area where prices had trouble getting above and literally collapsed. So it's not set properly, but if I do this, come on, cancel. Struggling a little bit with the drawing there today. Anyway, that's my area of resistance or supply. And sure enough, earlier today, prices bounced off that at the end of the day. Now, again, it takes a little bit of time to get used to finding these areas, but once you get good at it, it's actually pretty easy. Just takes a little bit of practice, that's all. This is what I was looking for. I wanted to separate. There we go. So obviously looking back now, this close, it's easy, but when you're looking at the charts, you just got to get used to it. And this is one of the things that I teach basically is how to identify those. Come on, why is it not going back? There we go. Use this. So during the middle of the day, you can look back and see where is price not likely to go. Well, we got that resistance or supply level. And then if we look back here, we have this level. Possible area of demand. And actually, if we go a little bit closer, you notice on the hard right edge of my screen, prices rallied very sharply off of this low. And that may be another closer area that we could use. Again, you just got to get used to it and learn how to identify where the imbalances are in price. That's all. So right there, we had two areas. I didn't really care for this one. It was too wide down below there anyway. And I'm not going to worry about it right now. You can see by the end of the day, we ended up closing within those ranges. So if you did a bear call spread here, bull put spread here, you were doing a lot of sweating, but ultimately profit. That's it. So getting back to the iron condor again, well, if we were setting something up, let me go to my Option Station Pro right there. Obviously, the market's already closed. That option is no longer available. But prior to that, if you did this, you go to iron condor, spread width. Let's do, whoops, why is it going that way? 1. You just put it in again. We're selling an option. So I click on that and I went to trade. Actually, I wanted to go to analyze. Doesn't matter, but right here I can set it up. It's got 5. I just put in the strikes that I want. So I don't remember the exact strikes where they are, but anyway, put those in. No, I'm not, Josh. And let me see. Jason said credit spreads are great. Yeah, you get high batting average, basically what you're looking for. And 0 days till expiration, you take credit spreads on the day. Yes, you can. I'll get a little bit more into that. Let me continue on here because we're running out of time too. Anyway, you're looking at selling a bull put spread below either 1 standard deviation or below a support level. Now, why did I say 1 standard deviation? Well, standard deviations, if you're not familiar, is a statistical way of figuring out where prices are likely to be moving. 1 standard deviation of price contains roughly 68% of all price action. So it's very unlikely that prices would go outside of 1 standard deviation and stay there. It can happen, but it's not as likely. So 68% of all price action should be within 1 standard deviation of price. So we could do the same thing. You see that a trader could sell a bear call spread, either 1 standard deviation above price or above a resistance level. So the prices stay within that level, the premium is collected and kept as profit. That's it. You see that the biggest number is not the delta, not the vega, but it's the theta. Basically, the option expires and you get to keep all the premium from selling that option. So how do we find opportunities? Well, I said a little bit about that. And remember, there are no guarantees with any strategies, right? You could, well, the alternative, Rodney's talking about short strangle. An alternative to this would be a short strangle. The short strangle is without buying the put or without buying the call. You do not do the buy legs. You're simply selling a put, selling a call. That can only be done if you're a level 5 options trader. You got to have the most experience and you got to have a certain amount of money in your account before an option platform will allow you to do that. So, but that is something you would collect a lot more premium, but you have potentially unlimited risk. So you have to know what you're doing for that. That's why the iron condor is a little more achievable for many people because it's a lower option level. It might be a 4 in order to be able to do that. But the risk is limited, again, to the difference between the 2 strikes minus the premium collected. And the nice thing about this is typically when you're trading an iron condor, only one side can lose, not both, right? So typically they're only going to require you, the brokers are typically only going to require a trader who's putting on an iron condor to bring in the margin for one side, even though you're trading both sides, because only one side can theoretically lose. Prices can't finish above and below this area. It can only finish above or below, right? There you go. Oh, no problem, Matt. You can catch up on the recording anyway. So, I said this before, when you're selling options, the face value is that you're going to have a much bigger risk than reward. This is done though, because the probability is much higher of winning. That's all. So I mentioned the strategy that I typically like to do on the SPX sample strategy here is the S&P 500 index, but you got to do the right one. Okay. You want PM expiration. There are some AM expirations. You don't want to do that. Okay. AM expirations mean when the trading stops at the end of the day, that closing price is not the settlement price. The next morning when the market reopens, they use that as a settlement price. And you can go to bed as a winner, wake up the next morning and you're a loser. That's not fun. So want to avoid that. So basically, depending on the platform you're using, sometimes you'll see AM options. Do not, I can't say don't deal with them, but I prefer not to deal with those. They increase your risk. Again, the options close in the evening, and then the next day when the market reopens, that's the settlement price. And you can't do anything about it because you're already locked out. So those are typically monthlies anyway. On TradeStation, if you use the right symbol, $SPXW.X, you won't see those anyway, because that is only showing you the PM settled index. So that's kind of the nice advantage of a TradeStation, to be able to have that one type of option there instead of all of them mixed in. Okay. I have no idea about commissions or what the fees are for that, for the options. That's something you have to check with the brokerage. Okay. The PM expiration is actually, no, it's at 4 p.m. Eastern, not 5 p.m. It's at 4 p.m. So when the bell rings, whatever the price is, that's going to be the settlement price. Okay. And basically, the other thing that's kind of nice is if you don't close out a position, it's not a day trade. So people who have smaller account sizes can't typically day trade because you need $25,000 a day trade. Remember, these contracts, first of all, it doesn't show it here, but they are 1256 contracts are treated for taxation purposes more like futures are than they are stocks. Secondly, if you get into a position and allow it to expire worthless at the end of the day, you never close the position, so it does not count as a day trade. If you close the position prior to the expiration, then it does count towards the 3-day trades you can have. Okay. William, you can actually just look me up on Google if you want. You'll find my information there. Just look for Brandon Wendell. You'll see everything. I'm also on all the major social media things, so you can look me up there too. Anyway, for smaller accounts, you got to be careful. You don't want to risk too much money, right? So for smaller accounts, strategies that require more than one spread might not work, meaning the iron condors. So for smaller accounts, many people might just want to do either bull call spread, bear call spread, or bull put spread. So again, a bull put spread is a bullish strategy where you put it, you basically sell a put below your support, or I call them demand zones, a little bit different. And then you would buy a lower strike put. And the buying of the lower strike put offsets the risk of the one you're selling. If you are bearish or expect prices to stay below a certain level, you use the bear call spread, where you are selling a call option above a resistance or a supply zone, and then buying a deeper out of the money option, call, basically, both calls. And if you have a bigger value in your account, then you could do both spreads potentially, which is the iron condor. It's nothing more than combining those two. So when and where? Well, if you do options on the day of expiration, you knock out all the overnight risk, right? Why would I want to deal with overnight risk when I don't have to? There are options, as you saw, that expire every single day. We go, well, let's keep it on iron condor. That's fine. But we can see we have 7th, 8th, 9th, 10th, 13th, 14th, 15th, and so on. So we can trade options that settle that same day rather than having to worry about overnight. The advantage is zero overnight risk. The disadvantage is you don't get as much premium. Okay. If you take a look at these options, the more time you have, the more value there is to an option. You can see if we go, I'll go to single, sorry, iron condor here. But just looking at, where are we here? 4,164. So we go to 4,130, for instance, this option that expires tomorrow is $32. But if you go to we'll just go out about a week or so here, 9 days till expiration. Come on, we were about 4,100. You can see it's much more expensive. Okay. So a couple of things you got to be concerned about. Obviously, I mentioned before, don't want to worry about overnight. So we put in options on the day of expiration. To reduce the risk, you can also put on the trade within the last 2 hours of the equity market before it closes. So typically about 2 p.m., you got 2 hours left until expiration. The time decay hasn't completely come out of the option yet. There's still enough money left in the premium that you can make a small profit. It's not going to be huge. It's not going to be wow on every single trade, but what you're looking for is consistency over time. If you consistently pull money, even if it's small, out of the market day after day after day, it adds up to a big sum. So basically doing options on the same day of expiration within 2 hours of the expiration, you have limited risk, right? That's it. And again, looking to do those options, I mentioned this already, it'd be smaller premium, but yeah, 3 to 5% adds up if you're doing that every single day, right? You do that over and over and over again consistently. So basically, you're wanting to sell puts below support or demand and sell calls above resistance or supply. So the trader's intention is just to hold in expiration, right? 2 hours, not 26 hours. Yeah, it did say 2 hours, didn't I? Yeah, last 2 hours. You had me questioning that. All right. And because there's no overnight risk. That's all. And the trader's intention is just to hold that in expiration. So the other nice thing, when you think about it, commissions are only going to be charged entering the position. There is no charge because the trader holds these in expiration. There's no closing of a position, so no commission on that. So here's the thing. If price is going to cross the strike of the option that's sold, that's where the loss starts to come in. The trader has a couple of choices. They can hold on expecting the zone to hold, the support resistance might bounce and you're okay. Or they can roll the position. The roll would be you close the position that you're in as a loss and reopen a new position in options that are expiring the next day. Unfortunately, by doing that, you're increasing your risk, but you are going to be collecting more premium that can offset the loss that was just taken. Okay. The other thing that can be done is closing out for a loss, a stop loss. So a lot of times when I look at these, for instance, today, okay, since that question just came up, an example of looking at what happened today. Well, we talked a little bit about this already. We zoomed in a little more, but looking at the market right around 2 o'clock, there was a little bit of volatility going on here. And I showed you there was this area right here that was a supply zone where prices started dropping. And as we went a little bit further past 2 o'clock, this established itself as a support level. It was actually really right here initially, kind of poked through it. So in reality, before 2 o'clock, oops, wrong way. That's what it was looking like. It was kind of a weak support zone, and that was a resistance area. So selling 4180, and let me write these down so I don't forget. Otherwise, I'll forget the numbers. I click over. So let's see, it was 4180. And we were looking basically at 4100. So you would go back to your Option Station Pro, bring up, and you do it as individuals and do what's called legging in rather than doing it as an iron condor. Sometimes it might be a little bit easier. It's just personal preference. But right here, you would go to the 4100, no, wrong day. And make sure I'm on the right day here. Obviously, these have closed already, but 4100, there it is. On the put side, sell the 4100, buy the 4095. I got to merge those. Actually, can I do that on this right now? No, actually, I got to go back and just do it as an iron condor. If it was live, I could do it separately. I forget how to do it all right now. But anyway, just do it like this. Easier. So iron condor. And I'm just going to click sell. And I'll change the numbers myself. Right here we have the puts and the strike. I'm on the wrong one here. I don't use this enough. Sorry. So let me just go ahead and fix this like that for trade. Again, do it. There we go. And put. That's I gotta do the one I'm buying first. So that would be 4095, 4100. And on the call side, it was 4180. So I'll do the buy first, 4185. There it is. 4195 put 41. Yep, perfect. So if I go to analysis here, it's going to let me see this one. It's not right now because I got to put in the analysis, analyze. There we go. Now it should work. Anyway, I'm not getting it right at this moment, but there it is. That's what it would look like. 40.95, 4100, 4180, 4185. And as long as prices stay between those two levels, the premium collected goes in the trader's pocket. And there it is, finished right there. So that would work. There's no reason to necessarily do it that early, Rasha. I mean, you could do it early at 9:40, but you don't know what's going to happen for the whole day. And you'd have to use higher time frame zones because the 5 or 15-minute zones may not hold up for the entire day. So typically, there will be more premium if you do it earlier in the day, but with more premium comes more risk, many more hours. So doing it in the afternoon, again, it lowers the amount of risk potentially. And also, to lessen potential loss, a trader could put on a stop loss. Now, to put on a stop loss, what you need to do is figure out how much premium will you be collecting. So in this case, I think the premium I collected today, and looking at this, was about 45 cents, 50 cents. So we go to 50 cents right there for the price, and it's not going to show everything right now, but the max profit would be the premium collected. The max loss in this situation would be $450, right? And what would happen is if you allow this to go to expiration and it expires out of the money, which it did, you get to keep that premium. And it doesn't count as a day trade because the trade was never closed. Okay. Yeah, if you exit, it's a day trade. And I don't know. I mean, that strategy may work for that person, but the strategy I prefer is getting in and getting out at the expiration. Getting in at the last 2 hours, getting out for the expiration. Again, you don't have to worry about the day trading for one. And also, you collect that nice premium over and over and over again. So I forgot where I was going with this one, but oh yeah, for the potential loss. What would happen is you take a look at the amount of premium that you're collecting and you decide how much are you willing to risk for this. What I typically look at is doing a 3-to-1. So if there's 50 cents being collected, when the premium is $1.50, I would close the position. Okay. And what would happen then, the ultimate loss would be $1 because remember, it's 50 cents collected, $1.50 to buy it back. Net loss is $1. So it's actually 2-to-1 loss. And that's just one possibility. You can find whatever works best for you. But if you do that, you can a trader can place a stop loss to limit the potential loss. The maximum loss would always be the difference between the two strikes, $500 minus the premium. So instead of taking a $450 loss to make $50, you could take a $100 loss potentially to make $50. Makes more sense. But because the nature of the trade is there's a high probability of success, that's why it's okay to take that potential loss. So that's it. And there's obviously a little bit more to that. The recording, yeah, it will be available. How hard is it to get filled with only 2 hours remaining? It's not always the easiest thing in the world, but depending on the number of options you do, if you're doing anywhere from 5, 10, even 20 options, it's relatively easy to get filled. There's still enough volume left before the end of the day to get filled. It's just a matter of what price you will get. You may not be able to split the spread 100%, but there's still opportunities there. And like I said, I've been doing this for many, many years now, and it's been working out very, very well. So I went a little bit over time here. Hopefully I got everybody's question answered here on the previous screen. This one. Yeah, like I said, the intention is always to hold into expiration. However, if that's not possible, if one leg is being threatened, you can either roll the position, okay, or it could be closed for a loss, or it could be, again, a stop loss can be placed on the trade to minimize the risk. Traders can do that. And you have to decide how much risk you're willing to take. Can you roll a spread? Yes, you can. Where can you learn more about placing stops on options? If you're doing it here on TradeStation, you have to, there's a bunch of videos out there on TradeStation. If you go to their YouTube page, there's plenty of videos on how to be able to do the different trades on OptionStation Pro. Okay. Oh, great, Donald. Yeah, I still use that as well. Quite a bit. It's another strategy I've been using for many years. See, rolling requires exiting. That would be a trade. Yes, if you do that. If you do close position before rolling, it is a day trade because you are actually closing position. If you hold to expiration, it's not. Okay. Make sure to get all these questions here. If the underlying pokes through and drops back, you still collect. Yes, as long as the close, the settlement price is within those options that you sold, the premium is collected. Personally, I don't do butterflies because I think it's much easier to pick a range where prices would be rather than an individual price. But the premium is going to be higher for a butterfly than it is an iron condor. If you're not familiar, the iron condor, you're selling a call and buying selling a call and selling a put at different strikes. The butterfly would be using the same strike. So it's just slightly different risk parameters. But it's more profitable because you're selling options that are closer to at the money, but there's greater risk. Okay. Can I show the bear put slide again? Can I recommend a mentor? I would love to help you. Bear call spread. You're probably talking about this one. Double diagonals. You can do that too. I mean, there's so many different types of strategies out there that you just have to find something that works right for you and find a mentor that you can work with that really works with you well. Someone that you can understand the way they teach and you like their style and you can put up with their voice. That's important too. Let's see. Are there any market conditions I would avoid doing the zero spread? Yeah, I hate doing the spread trade on the Fed day because the volatility is just insane. It spikes and drops so quickly that it is very, very, very risky to try to trade on the Fed announcement days. So thank you very much. As far as contact, again, you can look me up on all the social medias. I'm all over there. I'm not supposed to give out my actual personal information. You can also contact TradeStation. That was at TS University at tradestation.com, and they'll forward anything to me if you got questions as well. But yeah, like I was saying, you can contact me by just looking me up on Google. You'll find me at all the social medias as well. Let me make sure I got all these questions here. I'm going back a little bit here. And yes, the video will be out soon. They have to do some editing on it before it gets released. Any market condition? I answered that one. Yeah, trading at 2 p.m. Is it the best time to minimize the risk? It is a good time to minimize the risk. There's only 2 hours left. And generally right around 3 o'clock, you'll see the theta drop. So you'll see premiums drop right around 3 o'clock. So if you get in around 2 o'clock, then it's much easier and you get more premium than if after, too late. So somebody mentioned that you can do those sometimes at 9:30, 9:40 in the morning. Yeah, you'll have a lot more volume, a lot easier time getting in, but you have more risk throughout the day. And what was also mentioned is if you are entering and exiting in the day early, then you are day trading and you got to make sure you have $25,000 in your account. Okay. Let's see. You have a nice drawing to show from what? The paintings that I do, I have those. Let's see. How to find equities that trade weekly options? You can just do a search on the exchange and find ones that do that. Yeah, I have this one. Let me see here. Just since you're asking, this painting. I actually painted that. So, bear. Do I take brand new students? Absolutely. Try to help people from all levels of experience. Absolutely, 100%. So any other questions regarding this? Can TradeStation be programmed to do automated options trading? I don't know. You'd have to ask TradeStation people about that. So Jesus will probably be able to answer that in one of the master classes. I don't use the OVI indicator. No, I don't. Pretty much for the analysis, I use RSI and price action itself. That's pretty much it. Which options never get assigned? I don't know. I would say the ones that expire out of the money and are European style. So what else do I trade other than SPX? A lot of futures. Do a lot of futures trading personally. As far as options, I pretty much stick with just SPX. The bull put spread, yeah, I can show you that one too. Again, this is going to be available on our recording. So there's the bull put spread as well. It'll be on the TradeStation website, TradeStation YouTube page. And yes, I believe, I don't know if they put up the email address earlier, they'll do it again, but I think it's TSUniversity at tradestation.com is the email address that they use, and you can get a hold of me if you got questions there as well. Or like I said, if you just do a Google search and you'll find me on all the major social medias that are out there. And yeah, I do stuff there too. Thank you, Mary. I appreciate that. Yes, I will be posting more videos there as well. Have I looked at market profile, determine value, area, and range? I have, but I haven't used it recently. That is something that would be interesting to see how we could use that in the later part of the day, again, to figure out where prices might not go. And, that could be something that could be added to the strategy to figure out where to sell the options, obviously. So no, I do believe in market profile. I think is a great method of, a technical analysis tool. It has a lot of value. It's just, I can only use so many things. I have so many things going on. So I try to keep this as a very simple strategy. And I simply, like I said, look on the chart and try to find where my zones are for supply and demand is what I use rather than support and resistance, as I mentioned, and look to see where it's possible to get premium outside of those zones. So Joey, basically the question is, do I trade this iron condor on a daily basis or sometimes one side or the other? It depends what price is doing it. There's a very strong trend, then I may only do one side and not the other. So for instance, if I'm looking at a 15-minute zone, I will also look at the 60-minute trend. You see, we have a strong uptrend. Therefore, I might have a bullish bias and may be leaning more towards the bull put spread rather than doing the iron condor. But if I have a good area where prices are not going to go, then I can put on the iron condor. But yeah, absolutely, there are times where I do one side or the other, not both. But typically try to do the iron condor because you get more premium, which is nice. What kind of futures do you trade? Well, I trade pretty much, I do future spreads. So if you go back in history for TradeStation, I did a workshop on future spread trading back in, I think it was November. So you can look that up as well. But I do that. You can do that through TradeStation Futures Plus. Also directional trading, just the typical indexes, the energies. The 889 strategy, Chris, is a strategy that I came up with about 15, 16 years ago. And I've been teaching that to my students quite a bit. And what time frame chart do I suggest for day trading? There's not a particular one that works best for everybody. You've got to find the one that you feel comfortable with the risk. Personally, I trade a lot on 5 and 15-minute charts intraday, but that doesn't mean that's the only one. I have a lot of students who do very well on 2-minute charts. I see a lot of people trading on nothing less than a daily chart, and that's whatever you feel comfortable with. Let's see. That's just about it. Would I consider trading SPY or QQQ with the spreads? I prefer the European style options. So I will not do that. I'd rather do the index, as you can see, rather than using the actual ETF because those are American style. That's all. Okay. Yeah, that's not the only place, Paul. And I don't work for them. I know them. I used to work with a bunch of them, but I don't anymore. Anyway, any other questions regarding the weekly options we were just talking about? No, okay. There we go. All right, well, I want to thank everybody for being here. Hopefully you enjoyed this. And if you did and you want to see it again, it'll be posted very, very shortly. Just be patient. They got to do a little bit of editing first. Once again, if you want to get a hold of me directly, you can always look me up. You can email TradeStation, tsuniversity@tradestation.com. I'm going to turn it back over to Jesus. Thank you for having me here. Appreciate it again.
I was an active chat, right, Brandon?
Yeah.
It's great. It's great to get all those questions. Yeah. Well, excellent job. And let me just share my screen here for a moment. I want to say thank you, everyone that took some time to learn a little bit about, these type of strategies. And thank you, Brandon, also for your expertise. It's great to hear you out. I do want to encourage everyone to reach out. Go to tradestation.com. Use the email that has been provided, tsuniversity@tradestation.com. For any additional questions on this presentation, if you want to get a link to the recording or reach out to Brandon, reach out to us and we'll be glad to help you out, okay? Thank you, everyone, for attending this class, and I hope to see you again on a future class. Goodbye, everyone. Nice having you. you.